So a cash and carry trade is actually a very simple and also time-tested trading strategy. At its core, it's an arbitrage setup where a trader will take advantage of the difference in price between a derivatives contract and the underlying of that contract. In simpler terms, it means that when the price of, say, Bitcoin is at 50,000 and the price of a Bitcoin futures is at 53,000, and I'm totally making those numbers up, by the way, but you can profit off of that price difference, off of that premium between one and the other. Now, to stick to that example, the reason why a Bitcoin future would be more expensive is because the seller of that contract wants the buyer of that contract, of course, to pay for that convenience, for the right to buy a given amount of Bitcoin in, say, 3 months' time. If it's a future with a 3 months out expiry, meaning because there's a time component to a futures contract as opposed to just buying the spot, well, that has to be baked into the price. And of course, the further out in the future, the higher the premium, and the closer in the future, the lower the premium. So if you're a trader and you're willing to hold that trade until expiry, in our example, the next 3 months, it means that you can pocket that premium. Now you can look at the screen and think about it that way. If uh, oops, if the price of Bitcoin is 50,000 and a 3 month out futures contract is trading at 53,000, so there's a 3,000 US dollar premium. After a month, that price difference, that premium will be smaller because we're closer to maturity. So there's less time in that futures contract. And so the thing that had maybe a 3,000 US dollar differential just has maybe a 2,000 US dollar differential. And if you go 1 month further, so maybe you're 2 months in, there's just 1 month left. Instead of 3,000 at the beginning or 2,000 after a month, there's only 1,000 differential. So basically, you can see the difference between the future and the underlying, the premium, is going lower and lower. In other words, it's narrowing, it's shrinking until you hit expiry, where there's essentially no more time difference between the future and the underlying, and therefore there's no price difference either. Now, in practical terms, to put that trade through, you would have to sell the 3 months out Bitcoin future, which is worth 53,000, and buy the current or the spot Bitcoin for 50,000. And then you just have to wait until the end of the 3 months, until expiry. And at that point, the future price, just like on the screen here, the future price should have gone down to or be very close to the spot price. And then you can unwind the trade, either by buying the futures contract, which initially you sold, or just waiting until full expiry and then selling the Bitcoin, the spot Bitcoin that you actually had bought. Now, accounting for transaction fees and slippage, etc., you've more or less pocketed the difference between the futures contract and the spot contract. Now, I'll answer a question that maybe I should have put at the very beginning, which is, what do you need to put that trade through, and why would you choose to use that strategy? Essentially, you just need capital. And the more, the better, because the more capital you have, the better it is to take advantage of spreads. And you need time, you need patience. Because, of course, while that trade is put through, you can't use your capital for much more. So you're accepting to lock up those funds to get that return. But you have to wait until the future expiry. Now, to finish off, the reason why this is attractive, and you might not have picked up on that just yet, is because it's a market neutral strategy. Now, what does that mean? It means that you're actually making a profit without being exposed to the price movement of the underlying. So you're taking advantage of the price difference between two securities, but you don't care whether Bitcoin, like the underlying, is going up or down. Why? Because if Bitcoin goes up, and look at the chart here, if Bitcoin goes up, your futures contract that you sold, that you were short on, loses. You were short something and then it went up, so you're actually in a loss. But the Bitcoin that you bought is actually making a profit, and that's a good thing. So it's basically netting each other off. You're fully hedged, and you're just canceling out whatever profit or loss you would have from the price movement. And conversely, I'll actually show you a different slide. Conversely, if the underlying goes down, it's exactly the same concept. So you were short here and you bought here. As it goes down, the thing that you bought is losing value, but the thing that you shorted is actually making a profit. But at the end of the day, it ends up netting each other out. So you're neither in profit nor loss. You don't care. You're fully hedged. The profit happens with the time decay, the shrinking of that premium between future and spot, which you can see here as well. So that difference shrinks and you start to pocket it as time goes by. That's it.